Welcome to the deep dive. We've got two really interesting sources today from Accounting Podcast.
Yeah, that's right.
First, there's this detailed breakdown. It's dated March 13th, 2025, digging into the accounting side of tariffs, using data up to Q4 2024. And second, we have their March 2025 Global Trade Update. That one looks more at trade policy and, the latest global trade figures.
Right, so we're getting both the sort of micro company level view and the big macro picture.
Exactly. And our mission here is really to connect those dots. We want to pull out the crucial insights from both sources, understand how tariffs ripple through businesses, trade, even accounting, but, keep it clear and accessible.
Absolutely. It's fascinating how they interconnect the accounting rules and the global trade flows in early 2025. They really are two sides of the same coin.
Okay, so let's dive in at that business level first. Accounting for tariffs. When a company gets hit with a new tariff on goods in its inventory, what happens on the books?
Well, the guidance here, ASC 330, is pretty direct. That tariff cost has to be included in the cost of the inventory.
So it's not some weird abnormal expense.
No, exactly. It's treated just like any other cost you'd incur to acquire those goods and get them ready for sale. It's a routine acquisition cost.
Okay, so if I'm importing parts, suddenly there's a tariff, the cost of those parts on my balance sheet just goes up.
That's right. And, that sounds simple, but think about the knock-on effects. It directly impacts your cost of goods sold when you eventually sell the product.
Right, which can squeeze your profit margins if you can't just raise your prices.
Precisely. It might even force you to look at maybe sourcing domestically or perhaps focusing on different products less affected by tariffs. It has real strategic implications.
And this isn't just for inventory, the stuff you plan to sell, is it? What about, say, buying new machinery for a factory?
Good point. Same principle applies. If you're capitalizing property, plant, and equipment, PP&E, any tariffs you pay to get that asset in place and ready to use are part of its capitalized cost. That's under ASC 360 and also ASC 805 in business combinations.
So it increases the asset's value on the balance sheet.
It increases the cost recorded on the balance sheet, yes, which, of course, then gets depreciated over time.
Okay. Now, let's say a business can pass these costs on. Maybe they adjust prices for their customers. How does that work with revenue recognition under ASC 606?
Yeah, ASC 606. This gets interesting. It depends on the contract. If your contract with the customer already has a clause, like a mechanism that adjusts the price if tariffs change.
Like an automatic price escalator?
Sort of, yeah. Then that change is treated as variable consideration.
Oh, yeah.
The final price wasn't fixed. It depended on the tariff.
But what if there's no clause? You just have to go back and talk to the customer.
Right. If you have to renegotiate, then it's usually viewed as a contract modification. Or you might just factor it into future deals. How you account for that modification prospectively or with a catch-up adjustment depends on whether the remaining goods or services in the contract are distinct.
Got it. What about those, tariff surcharges you sometimes see tacked onto an invoice? Are those treated like sales tax, where the company just collects it and passes it on?
That's a really key point the source makes. No, they're not treated like taxes under the practical expedient in ASC 606.
Oh, okay.
So even if you call it a surcharge and it's clearly meant to cover the tariff, you have to include it in your total transaction price, in your revenue.
So it boosts your reported revenue, but also your costs, right, since the tariff is in your cost of goods sold.
Exactly, which means it can actually lower your gross margin percentage, even if the dollar amount of gross profit stays the same or similar. It's an important presentation point.
Okay. Now, thinking about longer projects, maybe construction or complex manufacturing, where companies recognize revenue over time using a cost-to-cost method. How do tariffs mess with that?
Right, the percentage of completion method. Well, if new tariffs increase your total estimated cost for the entire project.
Which they likely would.
Yes.
Yeah.
And if you can't pass that cost increase onto the customer through a change order or something, then your percentage complete, which is, costs incurred date divided by total estimated costs, actually goes down.
Because the denominator got bigger.
Exactly. So you end up recognizing less revenue in that period than you otherwise would have. It slows down revenue recognition.
And I suppose in a worst-case scenario, could these increased costs actually tip a project into a loss?
Absolutely. There's specific guidance, ASC 605-35, that deals with expected losses on long-term contracts. If it becomes probable that your total estimated costs, including these new tariffs, will exceed the total expected revenue from the contract.
You have to face the music.
You do. You have to recognize that entire expected loss immediately in the period you determine it's going to happen. It really highlights why negotiating price adjustments for tariffs is so critical on these big projects.
Wow, okay. So moving beyond specific contracts, tariffs can also raise red flags about the value of a company's assets more broadly, right?
Yeah.
Like triggering impairment tests.
Yes, definitely. They're a classic impairment trigger. For inventory, we talked about cost,
Mm.
but you also compare cost to net realizable value, or NRV basically, expected selling price less costs to complete and sell.
And tariffs could push the cost above the NRV.
They could. Or even if the tariff hits after the balance sheet date, it might impact your estimate of future selling costs or disposal costs, which are part of that NRV calculation.
So even post-balance sheet tariffs matter for NRV.
They can, yeah, for estimating those future costs. The source notes, though, that an unexpected tariff imposed after year-end usually wouldn't affect the cost component for the year just ended, but you'd likely need to disclose it if it's significant.
Okay. And what about the bigger assets? Goodwill or machinery, other long-lived assets?
Same story. Tariffs can be a major trigger. For goodwill under ASC 350 or other long-lived assets under ASC 360, it's not just about tariffs already in place. It's about market expectations.
So even the threat of tariffs could do it.
Yes. If the market anticipates tariffs that could significantly hurt a company's future cash flows, that expectation itself can be enough to require an impairment test. You need to assess if the carrying value of those assets is still recoverable.
So when you actually do the impairment test and you need to estimate the fair value of the asset under ASC 20, how do tariffs fit into that calculation?
They're a direct input. Fair value is, what a willing buyer would pay. And a buyer is definitely going to consider the impact of tariffs on future costs and profitability.
Makes sense.
So you have to build tariff assumptions into your valuation models, your cash flow projections. You might need to use an expected cash flow approach, weighting different tariff scenarios by probability to capture the uncertainty.
And it might even change which market you assume the asset would be sold in.
It could, yeah. Tariffs might make one market less attractive and another, perhaps previously ignored, the principal or most advantageous market. You have to think like a rational market participant reacting to the tariff environment.
This stuff really filters through everything. What about income taxes? ASC 740.
Right. Any pre-tax income adjustments driven by tariffs, higher costs, impairment losses, revenue changes naturally have tax effects. You need to recalculate your income tax expense, consider the impact on your effective tax rate.
And potentially on deferred tax assets.
Big time. If tariffs significantly hurt your future profitability outlook, that's negative evidence you have to consider when assessing if you'll actually be able to realize your deferred tax assets. You might need to record a valuation allowance against them.
Like a reserve.
Essentially, yeah. An accounting buffer saying, we're not sure we'll actually get the benefit of this future tax deduction. Tariffs can also complicate transfer pricing between multinational subsidiaries and potentially create uncertain tax positions that need evaluation.
Okay, one last accounting piece. Disclosures. What do companies need to tell investors about all this? ASC 275. Risks and uncertainties.
Transparency is key. If the estimates related to tariffs like future costs, NRV, fair values, potential losses could reasonably change in the near term and have a material impact, you need to disclose that.
Especially if it affects liquidity or going concern.
Exactly. ASC 205 FORDA on going concern is relevant too. Even if tariffs are imposed after the balance sheet date, management has to consider their potential impact when evaluating if there's substantial doubt about the company's ability to continue operating for the next year. It's a forward-looking assessment.
Okay, wow. That's a really thorough look at the accounting knots tariffs can create.
It really touches almost every part of the financial statements.
So, now let's zoom out. Let's shift to that second source, the March 2025 Global Trade Update. How does it frame the role of tariffs in the bigger picture of trade policy?
Well, it confirms they're still a fundamental tool for governments, primarily for two reasons. Protecting domestic industries from foreign competition, and especially for some countries, generating revenue.
Right. And it mentions that while global average tariffs have generally trended down over time.
Yes, thanks to, WTO agreements, regional trade deals, general liberalization.
The picture isn't uniform. Developing countries often face higher barriers.
That's a key point. Despite the overall decline, exporters in developing nations frequently encounter significantly higher tariffs, particularly in certain sectors compared to developed economies.
And for those developing countries themselves, tariffs play a complex role, right? It's not just about protection.
It's multifaceted. For many developing economies, tariffs are a really significant source of government revenue, sometimes funding a large chunk of the national budget.
Crucial for public services, then.
Absolutely. And they are used strategically to try and nurture nascent industries. Think agriculture, textiles, light manufacturing, giving them breathing room to grow before facing full-on global competition.
But it's a double-edged sword, surely. There must be downsides.
Oh, definitely. While protection might help initially, high import tariffs mean higher costs for everyone. Businesses using imported inputs, consumers buying finished goods. This can dampen overall growth and make domestic firms less competitive internationally in the long run.
And the report mentions something called tariff escalation. What's that about?
Right, tariff escalation. This is a really important concept. It's when tariffs on processed goods are higher than tariffs on the raw materials used to make them.
Okay, so low tariff on raw cotton, but a higher tariff on imported T-shirts.
Exactly. Or low tariffs on cocoa beans, higher tariffs on chocolate bars. This structure actively discourages countries from processing their own raw materials and exporting higher value goods.
Because their processed exports face higher barriers.
Precisely. It tends to lock developing countries into exporting lower value raw commodities, hindering industrialization and diversification.
Let's dig into some specific sectors. Agriculture seems like a hot spot for high tariffs.
It really is. Agriculture consistently faces some of the highest trade barriers. The report says developing country agricultural exports face an average MFN tariff of around 20%. That's substantial.
And it varies by region.
It does. Africa, South Asia, East Asia generally see higher agricultural tariffs than Latin America. And even in developed countries, you find these tariff peaks.
Exceptionally high tariffs on specific things.
Yes, on sensitive products like dairy, meat, sugar, things politically difficult to liberalize. And tariff escalation is very prominent in agriculture, too, making it tough to export processed foods.
What about manufacturing? Have tariffs come down more there?
Generally, yes, there was a slight decrease globally between 2012 and 2023, but they're still quite high in some regions like South Asia and Africa. And interestingly, textiles and apparel still have some of the highest average tariffs within manufacturing.
Which hits developing countries hard, as those are often key export sectors.
Exactly. Plus, the report flags the impact of recent retaliatory tariffs, like the U.S.-China ones, on things like office machinery, creating new spikes in specific manufactured goods trade.
Okay, and raw materials, like metals, fuels.
They generally face the lowest tariffs. That makes sense, right? They're essential inputs for global supply chains. Keeping those tariffs low helps keep downstream manufacturing competitive. Regional trade deals don't affect these much simply because the baseline tariffs are already so low.
Looking regionally, the report confirms that developing countries tend to have higher import tariffs overall than developed ones.
Yes, that's a clear pattern. Africa and South Asia stand out with particularly high import tariffs. South Asia also has relatively high export tariffs.
Export tariffs, taxing goods as they leave.
Yeah, sometimes used to ensure domestic supply or capture resource rents. Latin America has lower import tariffs than Africa or South Asia, but still significant export tariffs. East Asia, though, has much lower tariffs generally.
Why is East Asia lower?
Largely due to deep integration into global value chains and a high concentration of regional trade agreements that reduce barriers among partners in the region. Developed economies have the lowest rates and often give preferential, even zero tariff, access to developing countries, especially for raw materials.
So trade within regions with agreements is easier than trade between regions.
Generally, yes. Regional trade agreements, RTAs, lower tariffs between members. But trading with a country outside your bloc often means facing higher standard MFN tariffs. And even South-South trades, say between Latin America and South Asia, can face surprisingly high barriers.
So these regional blocs can create disadvantages for outsiders.
They can. Although the report suggests East Asia's success might be less about preferential tariff margins and more about fundamental efficiency and established production networks.
We mentioned the WTO and GATE aiming to lower tariffs. How successful have they been overall?
Pretty successful, actually. The report states about 2/3 of global trade is now effectively duty-free, either because the standard MFN rate is zero or due to preferential agreements.
But the remaining third?
That remaining third often faces quite high tariffs, especially, as we said, in agriculture and some manufacturing sectors like apparel.
Which brings us back to those tariff peaks. High rates on specific sensitive goods.
Exactly. Common in agriculture, textiles, apparel. And regions like South Asia and Africa show particularly high peaks in those key sectors for development.
And tariff escalation, again, the global view reinforces that it discourages value-added processing.
Yes, the global data confirms it's most pronounced in manufacturing overall. It creates a clear disincentive for raw material producers to move up the value chain. There are a few exceptions, like petroleum products or textiles sometimes, but the general trend holds and poses a real challenge.
Okay, final structural points. Bound tariffs and tariff water. What are those?
Right. A bound tariff is the maximum MFN tariff level a country has committed to at the WTO. It's like a ceiling, providing predictability for traders.
They can't legally go higher than that.
Not without renegotiating or facing disputes exactly. Tariff water is the gap between that bound ceiling and the MFN tariff they actually apply day to day.
So it's like policy space. They could raise tariffs up to the bound level.
In theory, yes, it offers flexibility, but the report notes that for many developing countries, this water is quite shallow. Their applied rates are already close to their bond rates. And if you factor in even lower preferential rates from trade deals, the real room to unilaterally raise tariffs is often even smaller.
That paints a really clear picture of the tariff landscape. Now let's pivot to the very latest update, the 2024 trends and the outlook for 2025 from the Global Trade Update. What was the big story in 2024?
Well, global trade grew significantly overall in 2024. Interestingly, services trade actually grew faster than goods trade.
Oh, really?
Yeah, and developing economies, especially big ones like China and India, generally outperformed developed nations, many of which saw a trade contract. A key negative, though, was widening trade imbalances. The U.S. goods deficit grew, as did China's surplus.
And heading into 2025, what are the early signs?
The start of 2025 looked relatively stable for trade flows, but the report sounds a strong note of caution. There are significant downside risks from rising geoeconomic tensions and increasing protectionism. China and India, though, seem to carry good momentum from late 2024.
Looking back at 2024 growth, was it smooth sailing all year?
Not entirely. While both goods and services trade grew for the year as a whole, the pace definitely slowed down in the third and fourth quarters.
Okay.
But the nowcast for Q1 2025 was actually positive, suggesting momentum might pick up again, and trade prices were pretty stable in late 2024.
And did that pattern of developing countries outperforming hold up throughout 2024?
Yes, largely. Developing countries overall, and especially trade between developing countries, South trade grew faster than trade involving developed nations. East and South Asia were major engines for that. But that Q4 slowdown in goods trade growth was pretty widespread across most regions.
So looking ahead at 2025, what are the main clouds on the horizon, the big uncertainties?
The report lists several key ones. First, ongoing shifts in trade policy, more protectionism, linking trade to non-trade goals like security or environment, potentially broad new tariffs hitting value chains.
The disruptions.
Big time. Second, spillovers from existing trade tensions, think retaliation, impacts spreading beyond the directly targeted goods. Third, more subsidies and inward-looking industrial policies, prioritizing national champions or climate goals in ways that might distort or restrict international trade, especially in strategic sectors.
And just the general economic outlook.
Yeah, that's the fourth risk, a potential broader economic slowdown. The report mentions things like falling container shipping demand indexes and low bulk shipping rates, potentially signaling weaker industrial activity ahead.
Okay, let's get specific. How did the major economies perform in Q4 2024, the latest detailed data?
It was really mixed for merchandise trade. China and India saw growth, especially exports for China. The U.S. saw imports rise, but exports fall. But Japan, the EU, Russia, South Africa, they all saw declines in both goods, imports, and exports.
And services.
Services trade generally grew, but the pace slowed for most big players. India and South Africa were exceptions, maintaining strong services trade growth.
And regionally, in Q4, still developing countries leading.
Yes, developing countries outperformed developed overall. South trade are strong. Latin America, East Asia, South Asia, Oceania all saw positive trade growth. But Europe and Central Asia contracted, and North America was below average.
What about those global trade imbalances we mentioned? Did they keep widening in 2024?
They did. The report says merchandise imbalances increased, getting close to the levels seen in 2022. The U.S. had the biggest deficit, China the biggest surplus. The EU actually swung to a significant surplus in 2024, and those big bilateral imbalances, U.S.-China, U.S.-EU, EU-China, remained very high.
There was talk in recent years about friendshoring or nearshoring reshaping trade. What happened in 2024?
Interestingly, some of those trends seem to reverse slightly, or at least pause, in 2024. For ensuring trading more with allies remained elevated compared to 2021, but actually decreased a bit during 2024.
Okay.
Yeah, and trade concentration overall fell, suggesting maybe a slightly wider base of trade partners. Nearshoring also declined in 2024. It might suggest supply chains are maybe becoming a bit more dispersed again, but the report stresses that geoeconomics and value chain restructuring are definitely still major forces shaping who trades with whom.
Finally, which specific sectors drove trade growth in 2024?
Office equipment and pharmaceuticals were strong performers for the full year. The energy sector, though, saw a big decline in trade value, likely due to price swings.
And in the last quarter, Q4.
In Q4, the big growth sectors were agri-food, communication equipment, precision instruments, and transport equipment. On the downside, apparel and extractive industries saw trade decline in that period.
So pulling all this together, it's just incredibly clear how tariffs aren't just abstract policy levers. They have these really concrete, complex effects from, the details of a company's inventory valuation right up to global trade patterns and national economies.
It's absolutely striking, isn't it, that interconnectedness, how an accountant figuring out ASC 330 for inventory cost is dealing with the direct fallout of a macro-level trade policy decision. A single tariff ripples through cost structures, pricing decisions, impairment tests, and then add up all those individual impacts and you see shifts in trade flows, competitiveness changing, maybe even impacting growth forecasts for entire regions.
It's definitely been an aha moment, connecting those dots, seeing how, say, a tariff surcharge discussion under ASC 606 relates directly to those broader trends in protectionism and trade imbalances we just talked about.
Right.
Yeah.
And I think that leaves us with a really important question, maybe a final thought for our listeners to chew on. Given this complexity, this uncertainty around tariffs and trade policy, what are the best ways forward? How should businesses strategize, and how should policymakers navigate this? What's the right balance between, say, protecting domestic jobs or industries and reaping the benefits of efficient, open global trade, especially when the landscape seems to be shifting so much? It's certainly something worth thinking about in whatever field you're in.